They told you gold had topped. They told you silver's run was finished, a fever that had broken. They said something similar in 1974, roughly 18 months before both metals resumed a climb that made the doubters look, in hindsight, like men who sold their coastal property the week before the tide came in. Before we wrap up, if you're serious about learning the silver market, I have something special for you. I've created a complete ebook called Silver Trading Mastery that takes you from a complete beginner to understanding professional level silver trading, technical analysis, risk management, and market psychology. Think of it as a one-time investment in your financial education, an educational resource you can keep coming back to as your knowledge grows. If you want to become more confident in the silver market while supporting the channel, click the link in the description below to get your copy. There is a species of wisdom that arrives only through duration, not from a textbook, not from a weekend seminar, but from 25 years of watching a market breathe in and out, inflate its own mythology, collapse under the weight of that mythology, and then, with a patience that would embarrass most of the people trading it, begin again. Markets, as the old formulation goes, do not repeat themselves. They rhyme. And the rhyme playing right now, for anyone still listening, is unmistakable. Consider where we actually stand. Gold, at last check, trades in the neighborhood of $430 an ounce, a level that, however imposing it might have sounded a decade ago, represents a retreat of roughly a quarter from the all-time high near 5,596 slurs that the metal touched at the end of January this year. Silver has fallen further in percentage terms, trading around $60 an ounce against a January peak just above $121, a correction of more than half. These are not modest numbers. They are the kind of numbers that make weak hands sell and strong institutions accumulate, quietly, without press releases. In the entire modern trading history of gold, there have been only 3 genuine structural breakouts, not the dozen false dawns that populate the financial press in any given quarter, but 3. 1971, 2006, and the one we are still living through. Each of the first 2 was followed by a corrective phase that, in the moment, felt final, felt like evidence that the enthusiasts had been wrong all along. And each of those corrective phases was followed by an advance that made the correction look, in the rearview mirror, like the best entry point of the decade. We appear, on the balance of evidence, to be somewhere inside the 3rd such correction now, and it may be tracking its predecessors with a fidelity that borders on the uncanny, though no honest analyst pretends that history repeats with the precision of a metronome. Here's the sentence worth sitting forward for. The question was never whether these metals would recover. The data on that point, while never a certainty, leans overwhelmingly in one direction. The real question, the one that separates the investor who captures a transformational move from the one who merely watches it happen to someone else, is whether the low is already behind us or whether one further, sharper, sentiment-crushing dip still waits somewhere ahead. That distinction is not academic. It is the difference between buying with conviction and buying with your stomach in your throat. Consider the 2 paths with the detachment they deserve. In the first, the recent stabilization in both metals, gold holding the low 4,000s, silver defending the upper 50s, is the genuine beginning of the next leg, a methodical grind rather than a dramatic reversal, the kind of climb that characterized the years following 2006, more than the vertical spike of 1980. In the second, this stabilization proves temporary. Some catalyst, a Federal Reserve surprise under Chair Kevin Warsh, an inflation print that reshuffles rate expectations, a further escalation from the Iran-driven volatility that has already pushed oil up and complicated the inflation picture this month, sends both metals to one final, sharper low before the real advance begins. Markets that produce that kind of false breakdown, historically, tend to snap back harder and faster than markets that simply stop falling. The deeper the flush, the more violent the recovery. That pattern is held with remarkable consistency across a half-century of precious metal cycles. What lends this more than the usual chart reading credibility is the sentiment backdrop. Positioning data and fund flow indicators that reliably flag prior generational lows, 2008, 2016, 2018, 2022, are, by several measures, approaching similarly stretched territory now. That is not proof of anything. Markets owe nobody a repeat performance, but it is the kind of exhaustion that has, more often than not, preceded recovery rather than continued collapse. There is also the physical market to consider, which tends to tell a quieter but more honest story than the futures pits. Silver has now run a structural supply deficit for 6 consecutive years, according to figures from the Silver Institute, with the shortfall for this year alone estimated in the neighborhood of 46 million ounces. Industrial demand from solar manufacturing and electronics running ahead of what mine supply and recycling combined can furnish. That kind of deficit does not resolve itself gently. It resolves through price, through rationing, or through both. And the tightness has shown up in places that matter more than any single headline number. COMEX registered inventories thinning relative to eligible stock, and physical premiums in Shanghai persisting even as paper prices in New York and London have wobbled. None of this guarantees an immediate resumption of the advance, but a market running a structural deficit while correcting on price is a different animal than one correcting because the underlying demand story has broken, and the two are worth distinguishing with some care. And there is a piece of this story that almost nobody selling you a newsletter subscription wants to say plainly, because plain truth rarely drives urgency, and urgency is what sells. So if this kind of unhurried, historically grounded analysis is actually useful to you, if it's cutting through the noise in a way the algorithm-chasing channels aren't, do something about it right now. Hit subscribe, not because I need the number, though I won't pretend it's irrelevant, but because what comes in the next part of this discussion is the macro picture that explains not merely where these metals may go over the next several months, but where the entire cycle may be headed over the next several years. And that number is likely to surprise you. Stay with me. Because if you think this correction is telling you to walk away, I gently suggest you're reading the signal backward. A correction inside a still intact structural bull market has historically been less a warning than an invitation. And the investors who can tell the difference between the two are, more often than the comfortable majority would like to admit, the ones who look back on this period as the hinge point. What follows is not a prediction dressed up as certainty. It's an argument built on evidence, offered for your own judgment. The most useful instrument for understanding where precious metals actually sit within the arc of a secular bull market is not, whatever the chart services would have you believe, the price chart itself. It is the ratio of gold to the S&P 500, a rough measure of how much capital the world's investors have chosen to shift out of paper claims on future corporate earnings and into the oldest form of money still trading. Examined across the last half-century with something closer to a historian's detachment than a day trader's anxiety, a pattern emerges that is as clarifying as it is, for the complacent, faintly alarming. Every genuine secular bull market in gold, 1971 to 1974, the resumption from 1976 to 1980, the long climb from 2001 to 2011, shared a defining architecture. In each case, the gold to equities ratio surged for years, sometimes the better part of a decade, as institutional and retail capital alike rotated out of stocks and into metal at a scale that dwarfed anything seen in the early stages of the move. The 1971 to 1974 rotation multiplied gold's relative value against equities roughly eightfold. The current rotation, however real, however responsible for genuine new highs in both metals, has been comparatively modest by that yardstick. 2 years of advance producing something in the range of a 2 to 3-fold relative gain against stocks is, measured against those prior cycles, a beginning rather than a culmination, assuming, and this qualifier matters, that the current cycle continues to rhyme with its predecessors rather than break from them entirely. There's a second piece to this. The three great secular collapses in gold, 1975 to 1976, the early 1980s unwind, the long deflation from 2011 to 2018, were each preceded by years of speculative excess, extended topping structures, erratic price action, sentiment curdling from enthusiasm into something closer to religious conviction. The current pullback, 5 to 7 months in duration and on the order of a quarter to just over half off the highs, depending on which metal you're measuring, lacks that architecture. There has been no multi-year mania. There has been no decade of relentless outperformance against equities that would set up the kind of reversal 1975 delivered. The preconditions for a 1975-style unwind simply are not present, which does not guarantee they won't develop, only that the base rate currently argues against it. What looks more probable, on the weight of the historical analogy, resembles 1972 to 1974 or 2001 to 2003, periods in which equity markets entered extended, unglamorous bear phases, and capital rotated into precious metals, not in the tentative dribbles of the past 2 years, but at genuine institutional scale. That rotation, if the analogy holds, has not yet fully arrived. Valuations, monetary conditions, and the fiscal backdrop all point toward a stretch, perhaps 6 months out, perhaps 18, in which the long equity bull gives way to something more sobering, and a meaningful share of the capital displaced by that transition finds its way into gold and silver. If that unfolds as prior cycles suggest it might. The case for gold eventually testing $7,000 to $9,000 an ounce over a 3 to 4 year horizon, and silver working back toward and potentially through its January high near $122 toward the psychologically weighty $150 to $200 range some analysts have floated, becomes considerably less speculative than it currently sounds to skeptical ears. None of this is guaranteed. Markets have humiliated more confident forecasters than this one, It's worth noting the backdrop reinforcing this thesis in real time. China's central bank reported its largest monthly increase in gold reserves in roughly 2.5 years this past June, the kind of quiet, deliberate accumulation that has characterized official sector buying throughout this cycle, and one that rarely reverses itself on a quarterly whim. Meanwhile, minutes from the Fed's June meeting revealed a policy committee wrestling openly with inflation concerns, with markets now pricing something in the neighborhood of a 60% probability of a September rate hike, a genuine tightening bias in an environment where oil has jumped on renewed Iran-related tensions, which is precisely the kind of stagflationary tension precious metals have historically been built to weather. That tension sits uneasily alongside a labor market that has begun to soften in ways the headline unemployment rate doesn't fully capture. June's jobs report showed roughly 57,000 positions added against forecasts, calling for something closer to 110,000 to 115,000, a miss wide enough to complicate the Fed's calculus considerably. A central bank confronting both sticky inflation and a cooling labor market simultaneously is a central bank with no comfortable option, and markets caught between those two pressures have historically found their way, eventually, to hard assets. None of this is offered as certainty. The Fed's actual path could easily surprise in either direction, and geopolitical de-escalation, a genuine, durable one, rather than the on-again, off-again pattern of recent weeks, would remove one of the more visible props under current prices. The honest position is that the preponderance of evidence leans toward continued accumulation and eventual advance, not that the outcome is preordained, which brings us to the practical question, the one on which everything else in this analysis ultimately rests. How does an investor actually position for returns of the magnitude this history implies? The answer is less obvious than most assume, and it deserves the same rigor we've applied to everything else here, because being directionally correct about where gold and silver are headed means very little if the specific instrument you own fails to capture the move, or worse, magnifies the wrong kind of risk. If this kind of unhurried, historically literate analysis is the sort of thing you've been looking for and not finding elsewhere, the comment section below is where the real conversation happens. I read everyone, and the sharpest objections there have sharpened this analysis more than any single data source I could name. Tell me where you think this reasoning breaks down. Tell me what your own research is showing. Stay with me, because what follows next, the specific framework for translating a correct macro view into an actual portfolio, is the part almost nobody bothers to explain properly. And it is the part that separates people who were right about the trend from people who actually profited from it. There is an uncomfortable truth embedded in precious metals. Investing that bull market enthusiasm tends to paper over. Being correct about the direction of gold and silver does not, by itself, generate wealth. The broad mining indices, the ETFs that own everything indiscriminately, simply because it's a mining company, will capture some portion of any advance. But the historical record, examined with the same rigor applied to the price charts above, reveals something less comfortable. Companies at the top of the quality spectrum have tended to outperform the broad index by a margin that isn't incremental but categorical. Companies at the bottom, the ones that attract capital during a bull market precisely because enthusiasm has temporarily suspended ordinary diligence, have tended to disappoint even when metal prices behaved exactly as the bulls predicted. The distinction between a well-run producer with genuine assets, disciplined management, and a balance sheet built to survive adversity, and a company that merely owns promising ground in a fashionable jurisdiction, is not a matter of degree. Historically, it has been closer to the difference between a 3 to 5-fold return and a permanent loss of capital, sometimes within the very same macro environment, over the very same stretch of time. That is not speculation on my part. It is the empirical record of every precious metal cycle stretching back half a century, and it is the record that ought to discipline every decision made in this one. Consider what quality actually looks like with gold above $400 an ounce and silver above $55. Margins for the best-run producers, at these prices, are running at levels their counterparts a decade ago, operating with gold near $200 or $500, would scarcely have believed possible. And the market, characteristically slow to reprice what it has not yet been forced to acknowledge, has not fully caught up to what these companies are actually worth. At current metal prices, let alone at the higher prices this analysis suggests may lie ahead, layer the forward variable onto that picture. If gold does work its way toward the $7,000 to $9,000 range over the next several years, as the capital rotation argument above suggests it plausibly could, the earnings power of a well-run producer does not merely rise, it compounds, because fixed costs don't move while revenue per ounce does. A company earning several $100s of margin per ounce at today's prices could see that margin multiply several times over at meaningfully higher gold prices. And for a company with expanding production, the effect on the bottom line is considerably more than linear. This is one of the more powerful, and more frequently misunderstood, wealth compounding mechanisms available to ordinary investors in this sector. The caveat matters as much as the opportunity. That same leverage runs brutally in reverse for poorly capitalized companies, over-promoted stories, or management teams better at narrative than execution. Mining history is littered with the wreckage of geologically exciting, jurisdictionally safe, impressively credentialed companies that nonetheless failed to convert a rising metal price into shareholder value because the underlying business simply wasn't built to capture it. The lesson isn't merely that quality tends to outperform, it's that quality is close to the only thing that reliably does, and the appearance of quality without the substance is arguably more dangerous than obvious mediocrity because it's the one that actually attracts the capital before destroying it. The practical framework that follows from this is not complicated, though executing it with discipline is harder than it sounds. Look for the asset quality, grade, scale, and a jurisdiction that won't nationalize the mine out from under you. Look for the people, a management track record built on capital discipline rather than promotional flair, ideally one that has already survived at least one prior downturn without diluting shareholders into oblivion. And look for the balance sheet, one built to survive adversity while still funding growth, rather than one dependent on perpetually accommodating capital markets that may not remain accommodating indefinitely. A company that satisfies all three criteria, purchased at a valuation reflecting today's metal prices rather than tomorrow's speculative ones, has historically offered the potential for returns in the 3 to 5-fold range over a 2 to 3 year horizon on current margins alone, and considerably more than that if the macro case for higher metal prices continues to play out, as this analysis suggests it may. It is worth saying plainly what this framework is not. It is not a shortcut, and it is not a guarantee. It requires reading balance sheets rather than press releases, checking production guidance against actual delivered results over several quarters rather than one, and resisting the pull of whichever ticker happens to be trending on a given week. The junior end of this sector in particular rewards patience and punishes impulse with a consistency that borders on the mathematical. For every story that becomes a multi-bagger, several more become cautionary tales. And the difference between the two is rarely visible from the outside until well after the fact. That is not a reason to avoid the sector. It is a reason to approach it the way a careful historian approaches a primary source, with respect for what it can tell you and appropriate skepticism about what it cannot. 25 years of studying these cycles produces no certainty. Nothing in markets does. What it produces is the discipline to read the accumulated evidence, the price action, the sentiment extremes, the capital flow data, the historical analogs, honestly enough to form a probabilistic judgment rather than a hopeful one. And on the weight of that evidence, honestly assessed, the setup in front of us right now resembles the early stages of something considerably larger than the move already behind us, built on companies chosen for quality rather than excitement, purchased at prices that reflect where things actually stand rather than where the promoters wish they did. That's the analysis, offered for your own scrutiny rather than your blind acceptance. Leave your sharpest objection, your most pressing question, or simply what your own portfolio is telling you in the comments below. I'll be there. The real refinement of any argument like this one happens in that conversation, not in the video itself, so be part of it. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk.